Just last week, I had the absolute privilege of sitting down and recording a new podcast episode with Guy Spear of Aquamarine Capital. Now, Guy is an investor that I've been following for several years, and it's always a pleasure to get the chance to speak with Guy, and there's always lots of kind of nuggets of wisdom that come out of those conversations. And I have a couple of bits of exciting news. The first one is that about 1 hour after this video goes live, the full conversation with Guy Spear will be live on the Investing with Tom podcast YouTube channel. So if you're interested in checking out the full discussion, definitely head over and check out that episode with Guy, hopefully after you watch this video. And secondly, I want to share a couple of clips from that interview with Guy that I really got a lot of value out of, particularly around his thoughts on destination analysis, an idea that he kind of got from William Green's conversations with Nick Sleep, where Nick Sleep was trying to pick the companies that had the best destination, not necessarily the companies that were performing the best today or that looked the cheapest on a simple price to earnings metric or something today, but the companies that would have the best possible future. And that's really one of the reasons that Guy is able to hold on to the companies in his portfolio for a long period of time. So I want to play a short clip around Guy Spear talking about destination analysis, and then give an example of a couple of the companies that he wrote about in his recent annual report for his Aquamarine fund, which those reports are now publicly available, by the way, if you want to go and check those out. So that will also be linked down in the description. And finally, I want to share another clip from that interview with Guy where he talks about how he is sort of positioning himself for rising interest rates and high levels of inflation. So if you enjoyed this video, be sure to hit like and also subscribe if you are new here. But for now, let's play that first clip with Guy Spear talking about destination analysis in his portfolio.
For what it's worth, you probably, if you look in India, you'll see me as showing up as a shareholder, at least in a couple of companies. But interesting enough, I haven't made any moves there either. So the portfolio has stayed pretty static through this period. William Green, in talking about Nick Sleep, in Richer, Wiser, Happier, talks about destination analysis. Look at where you want to end up and then rewind from there. And I think that there are so many businesses that I've watched friends of mine own where I just say, I can't see the destination. It looks really sexy right now, but what's the destination? And if the destination is not somewhere that I want to be, then I'm not going to invest in it. And I maybe many of us have experienced the thing of the one night stand or the drunken night in a bar, and then there's a kind of the wolf syndrome where you want to bite your arm off because you find your arm off underneath somebody that you really don't want to be around the next morning. That is an example of not engaging in destination analysis. An example of engaging in destination analysis is to only hang out and certainly only go home with people you'd want to spend the rest of your life with, because then the destination is a positive destination. You never ever in investing want to wake up and discover that the thing that you thought you were getting married to really ought to have been a one-night stand. And so every single company, and I've done this with companies where people say this is a spectacular business and they're making so much money and they're not that expensive. And my answer to them is yes, but I don't know where the end point is. I don't know where they end up, and I want to know where they end up. And when every single company in your portfolio is one where I can see my way to an endpoint that is a good and positive endpoint that I want to be in, then that's something that you want to own for life. That's something you want to be married to. And what you really want to do is make sure that whatever company you take home with you to get is one that you actually want to get married to. And every single company that's in my portfolio, I want to be married to that company.
Now, as you can see from those couple of clips with Guy, he has a very strong focus on companies with a good destination. And he actually wrote about 3 companies sort of in relation to this topic in his recent annual letter to shareholders. Now, 2 of those companies he actually purchased and ended up in the portfolio and have performed very well, which are BYD and Indian Energy Exchange. And 1 company he actually passed on, which was a French lottery company, which I won't attempt to pronounce. I will put up the name of that company here. And it was really interesting the way that he basically looked at those companies. The investment in BYD actually happened right back in about 2011, and it was initially sort of a cloned investment idea from two people, being Li Lu and Charlie Munger. We saw Charlie and Li Lu sort of investing together, where Charlie had money with Li Lu's fund and Li Lu invested in BYD in a big way. And we also saw actually Berkshire Hathaway take a big position in BYD and sort of following Li Lu into that company. And Guy Spier openly admits that when he first made the BYD investment, it really was on the fringes of his circle of competence. He is not going to be the most sort of schooled up investor in terms of understanding electric vehicles and battery technology and that sort of thing, but he did know a couple of core ideas as it related to BYD. We knew that electric vehicles were very likely to have a long runway of growth. We knew that the people running BYD were very talented and also had a lot of integrity. And he also knew that the price was right and the allocation that he could put BYD into his portfolio kind of at cost was about right for his sort of temperament as well. And Guy Spier actually went forth and made a 5% investment in BYD. The thought process behind that basically being that if BYD worked out extremely well, a 5% position would be enough to generate meaningful extra return in the portfolio, but it was also small enough to where he didn't have to kind of stay awake at night thinking about all the things that could possibly go, right or wrong with BYD. Which potentially could be the case if he had gone forward and made a 20% or 30% bet or taken some sort of huge swing at BYD. And interestingly, in the case of that company, the financial results for BYD were extremely good over the next few years. They continued to grow and compound the business, but the stock price really didn't move along all that much for a long period of time. But Guy Spier knew that he was comfortable with his 5% allocation. He knew that the company had a good destination and that in 5 or 10 or 20 years, BYD was likely to be a much larger and more profitable business. So he continued to hold. And many of you will know the story with the recent stock price performance from BYD, that valuation eventually caught up to the business results, and BYD is now more than a 10x from where Guy Spier purchased it, and it makes up a huge percentage of his fund. It actually is basically the same size as Guy Spier's Berkshire Hathaway position, which is the largest investment that you will see when you look at the Aquamarine 13F. And along similar lines of investing in companies with a good destination, Guy Spier referenced a couple of Indian investments in that clip that we played earlier. And one of those Indian investments that he wrote about in his letter is Indian Energy Exchange. The idea basically with Indian Energy Exchange is that the demand for power, for electricity in India is very likely to grow significantly over time. And that's going to require more sort of facilitating of trading of power. And when you look at the Indian market for the trading of power, Indian Energy Exchange are definitely the dominant player and have almost like a monopoly on that industry. And of the kind of current amount of power traded in India at the time he made the investment, it was only about 10% of all kind of electricity versus about 70% in very developed European countries. So he knew that there was a long runway for that percentage to kind of go upwards over time in terms of the amount of power that was traded in India. And he also knew that there was a tailwind in terms of the absolute demand for power as well. And although Guy Spier didn't pay an exorbitantly high price, he did pay sort of a fair price and paid up a little for Indian Energy Exchange. But he's confident that it has a very good destination moving forward. And already Indian Energy Exchange has been a 3 or 4x return since adding it to the portfolio. Now, in contrast, the third company Guy Spier talked about in his letter that he didn't add to the portfolio was this French lottery company. And he basically looked at the business, looked at the financial statements, saw that it was an exceptional business from a financial point of view where it could grow, it was earning a very, very high return on capital, but he really didn't like the destination, much like a tobacco company where he just kind of didn't think it's a good thing for the world. He ended up actually passing on that company, and in recent times there's actually been an investigation into anti-competitive practices at that French lottery company. So those three businesses hopefully just speak to why Guy Spier is heavily focused on companies that have a great destination and they're heading to a very, very good place in the future. Now finally, let's look at one more clip from the conversation with Guy Spier, this time where Guy is talking about high levels of inflation and increasing interest rates, and how he thinks about positioning his portfolio to do okay through that type of environment.
I talked about going to inflation and higher interest rates in a time of extraordinary uncertainty. And I asked myself, and I asked the reader, where do you want to be as you go through this period? And the answer, and I reasoned through to an answer, which basically says, you want to be in these businesses. And, maybe there's a selection of the businesses that you want to, this is where you want to be. And, just very briefly, I used the analogy of, if we just imagine all stock investing is real estate, if you already own the best real estate in town, you own the best office building, you own the best McDonald's franchise, you own the best shopping mall right down there next to Trump Tower, let's say, and the storm is coming, whatever it is, do you really want to go and buy warehouses on the edge of town? Do you really want to sell your real estate and buy and hold cash?
Now, as you can see from that clip, Guy very strongly believes that the best way to combat high levels of inflation and increasing interest rates is to, again, own companies with a very good destination. He sort of compares it to a real estate investor, where if you owned prime real estate in the middle of town, or you owned a McDonald's franchise, you probably wouldn't want to sell up and buy a warehouse on the edge of town, or you wouldn't want to kind of sell up and have money just sitting in cash, wherein you're going to have a lot of your sort of purchasing power inflated away through periods of very, very high inflation. And to me, there's a lot of alignment here with what Warren Buffett has said in his previous annual letters and things as well about investing through periods of high inflation, and that is that you really want to be invested in businesses that have a lot of pricing power. If you own a business with a great brand where they can put their prices up every single year at or even above the rate of inflation, then you're going to be very, very well protected from rising costs generally, and you're going to be much more well protected than very capital intensive businesses, or potentially even some commodity businesses that don't have a lot of control over how they price their products. A lot of those commodity companies tend to be price takers rather than price makers, I guess. Whereas if you have a Ferrari in the case of Guy Spier, or a Coca-Cola in the case of Warren Buffett, you do have a lot of control around where you price your product, and you're able to kind of work your way through highly inflationary periods a lot better than the average business. So I hope you enjoyed those couple of clips from the conversation I recently had with Guy Spier. Now, as I say, about an hour after this video is live on the Investing with Tom YouTube channel, the full hour and a half long podcast with Guy Spier will also be live on the Investing with Tom podcast YouTube channel. So definitely head over and check out that full conversation if you're interested. Let me know what you think. It was very fun, and we covered many topics outside of the ones kind of covered in this video. So I think you'll enjoy that one, and I'm excited to kind of hear your feedback on what you thought of that conversation with Guy. But that is it from me for this video. If you did enjoy it, please hit like and also subscribe to the channel if you are new here, and I will see you in the next video. Cheers.